Good morning, everyone, and welcome along to this morning's Managed Accounts webinar. For those I haven't met, my name's Craig Hickson. I'm a Director Advisor Business here at Betashares and State Manager for our Queensland Advisor Business. It's my pleasure to welcome you along to this morning's webinar. And let me say up front, thank you very much for taking the time out of your day to dial in. First up, let me introduce our presenters for this morning. So first up, we will have Betashares Chief Economist David Bassanese, who will give an overview of, I guess, investment markets and the economy at the moment, and then how those changes have manifested in the Betashares SMA portfolios. And then at the end, we will have a presentation from Betashares Head of Practice Development, Damon Riscalla. So Damon will give a bit of an overview of some of the services Betashares has built out in our practice management offering. Before we start, just very quickly, we'll jump to the disclaimer. So everything we talk about this morning is general advice or general information. So please do your own research before acting on anything we talk about this morning. Before we start as well, we will be recording this morning's session. So a recording will be sent to all attendees, and please feel free to share with any interested colleagues who were unable to dial in this morning. There will also be a facility for questions this morning. So on the right-hand side, you should have a chat box there. There is an item that says questions. If you have any questions for either of our presenters, please just type them in the question box, and we will endeavour to get to any and all questions that come up this morning. Also, just in terms of ongoing communications, Betashares delivers a lot of educational and informational content on our website. So if you haven't, please visit the website regularly for fund information, for practice management information, and for regular commentary. Dave does a weekly blog, Bassanese Bites, that comes out every Monday morning. So if you haven't signed up for that, there is a facility on the website to do that, or else please let me know afterwards, and happy to add you to the distribution list for that. And finally, social media, there's plenty of content delivered via X, LinkedIn, Facebook, Instagram, YouTube. I think we've covered all of them there. So yeah, so please stay in touch via those channels. Just a quick update at the start in terms of Betashares as a business. Betashares now manages in excess of $30 billion. We now have 83 ETFs available in Australia, with another 5 available in New Zealand. Most recent, we launched 2 new US Treasury ETFs in the last fortnight. So a US inflation protected ETF and a US 10-year Treasury ETF. So they're the 2 most recent ones. Have over 130 colleagues in the business now. And just to touch on where Betashares sort of sits in terms of the industry, Rainmaker Research put out a regular assessment of flows on the industry. So this is not just ETFs, this is all fund managers in Australia. Most recent update came out in the last week or so. So this is net flows by asset managers ranked for the 12 months to the end of June. And you can see that we're very happy to see that Betashares ranks #1 in terms of net flows for the 12 months. But I think what is also interesting is that 3 of the top 4 managers now, in terms of net flows for the last year, are ETF managers. So obviously Betashares is very happy to be #1, but I think it speaks to the mainstreaming and the adoption of ETFs across investor portfolios that 3 of the top 4 managers by flows are ETF managers. Just moving on quickly, so the topic of today will largely be around the Betashares Managed Accounts, and everyone we sent invites to this are people who either currently invested or have clients invested in Betashares Managed Accounts or have shown some interest in that. So on the page there is what the current portfolios look like. And then if we go on, I'll just quickly sort of cover some of the key points of differentiation. Obviously, there are a lot of managed accounts available in the Australian market now. In fact, in excess of 150 billion in managed accounts. Betashares manages over $1 billion in our own managed accounts. But the differentiators for ours versus some of the other offerings is, firstly, Betashares is obviously Australian based and Australian managed. So we like to think our portfolios are constructed with Australian investors at the forefront. Secondly, whilst they're all ETF portfolios, they're not all Betashares. We do construct them with a best of breed approach. So currently that encompasses Betashares and Vanguard ETFs, but that could change at some future date. But we do build them with a best of breed approach. We do run a dynamic asset allocation process, and Dave will sort of speak to, Dave chairs the investment committee and provides the macro insights into the portfolios, and he can talk a little bit after this around what the current views and how that's manifesting in portfolios, focusing on sort of the big calls in portfolios. So how much in growth, how much in defensive, how much in Aussie, how much in global, and the like. In terms of other differentiators, we do use a mix of sort of low cost, market cap weighted, plain vanilla index exposures with some smart beta exposures that offer the opportunity for alpha generation, and Dave can touch on how some of those have done over the most recent period. We do cover all asset classes in the portfolio, so we do cover complete asset allocation. And then finally, the service proposition, and Damon can speak to some of the additional services that we can offer in terms of practice management and the like, outside of just being an investment provider. So with that, I will wrap up my section and I will hand over to Dave. As I said, if you have any questions, please click on the question box and type those in as we go. When Dave finishes, he will hand over to Damon, and then I will come back at the end to wrap things up. So over to you, Dave.
Thanks very much, Craig, and great to be with you all today to go over the sort of the sort of dynamic and the macro underpinnings of the models. I'm going to talk for about 20-25 minutes, and there'll be a little time for questions. So if you do have any questions out of anything I have said, just sort of submit them, and we'll go through them to the extent there's any there. So just from a big picture point of view, this is how the dynamic asset allocation is set at the moment. And look, the way, as Craig mentioned, the key underlying strategy of this is to focus on the big picture decisions, or sort of another way to think about it is the 80-20 rule. I mean, what sort of alpha can be generated from asset allocation? You can get very micro, picking individual companies to picking individual bonds. I mean, some people do that, some active managers, picking individual countries or like low, small cap European value stocks or something like that. We focus on basically growth versus defensive assets is the first issue, equities versus cash and bonds. And then we have intra-equity tilts, and we focus on two there, Australian versus global equities, and listed property versus Australian equities. And then within defensive assets, we have intra-defensive tilts, i.e. cash versus bonds, and global versus Australian bonds. Now, we don't necessarily always have tilts in all of these areas. Just depends on, how we perceive markets, where we see value at the moment. So with that background, as you can see here, the first question there is, we are neutral, and I'll go through this with the slides. We are neutrally positioned in terms of growth versus dynamic at the moment. So for a few quarters there, we were underweight equities, fearing a US recession driven by central bank tightening to deal with inflation. As it's turned out, as I'll get into, inflation has been easing, growth has remained pretty resilient, and the chances of a soft landing, i.e. inflation coming back down to target without the US economy and hence the global economy needing to go into recession, have receded. And as a result, we've gone back to a neutral position on that. Now, you may get a pullback in the markets in the short run, but our framework is corrections in the markets outside of recessions or material risk of recessions are very hard to time, and we don't try to get too cute in doing that timing. The one major tilt the tilt we do have at the moment in terms of DAA is bonds within the defensive areas of the market. So you can see that overweight bonds, and as I'll touch on, it really boils down to, we think we're close to the end of the tightening cycle. Central banks aren't talking about rate cuts next year, but if inflation continues to fall, even without a recession, they will probably cut interest rates next year. But at the moment, they don't really want to signal that too much because they are still trying to, slow growth, get inflation down. And we actually, the sell-off in bonds in recent weeks, to me, has been overdone. And if anything, it sort of makes the bond market even more value. The other tilts, and I'll get into, we're at the moment carrying a neutral position, Australian versus global equities and Australian versus global bonds. As Craig may have mentioned, a part of our portfolio is that our strategic allocation to global equities is 60%. So we do give you good global diversification straight off the bat in terms of the SAA by having a 60% allocation, which has actually played pretty well over the last year with global markets outperforming. So firstly, so here's a chart of global PMI indices around the world, and you've got the composite, which includes manufacturing and services. And then you've got it broken down by region, the composite index, the US, Euro, and China. And the Goldilocks zone there is 50 to 55. So these are sort of these indices, what percent of activity is improving versus not improving, and they survey businesses. And so when these indices are above 50, they say on balance conditions are improving. And when it's heavily negative, conditions are obviously not improving. Typically, when these indices get below 45 or lower, it's consistent with recession. We did dip there briefly in 2020, obviously in the GFC, the 2001 recession, they did dip down there as well. At the moment, you can see they are in this Goldilocks zone where things are not too hot, not too cold. Manufacturing is somewhat weaker, that even that's starting to recover. And really what we're seeing there is manufacturing basically had a lot of disruption due to the COVID lockdowns. We got a surge in demand for goods, which led when the economies reopened, led to a bounce back in manufacturing. But as that's unwound, manufacturing has softened as demand has shifted from goods back into services. But I guess the key point here is that global growth overall has remained resilient to the interest rate rises over the past year. At the same time, that has not come at the expense of inflation, particularly underlying inflation remaining stubbornly high. So I've got a chart here of US core consumer prices in the top left corner. You can see that it's gone from just over 5%. So this is stripping out volatile food and energy prices, which did go higher and have fallen faster. But underlying inflation, you can see, has gone from just over 5 to just under 4. And if you break that down into goods, housing, and services ex-housing, you can see most of that decline so far has been led by goods inflation. So goods inflation looks to be on the way back to sort of pre-COVID levels, where, again, if you look at that orange line, if anything, we had mild deflation in the goods sector prior to COVID. And I think that's sort of where we're going back to. Supply chain bottlenecks are easing. The initial surge in demand for goods during the lockdown has certainly abated. The grey line there is housing. Now we do, in fact, the bottom two slides there show you some of the drivers of goods inflation and housing inflation. So firstly, there's an orange line there in the bottom right. It's the supply chain pressure index. It's an index of things like supply delivery delays, cargo freight rates, but it's a compilation of things that measure pressure in global supply chains, inability to deliver goods in a timely manner. And you can see that has fallen. In fact, it's fallen right back to pre-COVID levels, and associated with that inflation, goods inflation has been easing. Secondly, if you look at the housing measure, again in grey there, that basically follows, so that is principally US rents, and that follows house prices and rents in the market with a lag, because without getting into the complications, just take it as read that when house prices are flattening off or falling, with up to a year's lag, it tends to flow through into the housing inflation measure within the US. And you can see there that housing inflation has gone from a 20% annual rate a year ago now down to flat. And so over the course of the next 6 to 12 months, there's a very good chance that housing inflation is going to go from something like 8% all the way back down to maybe 2 to 3%. So two of the key drivers of underlying inflation moving in the right direction, very, very important. The other driver, as you can see there, is that tan line, which is core services ex-housing, which is largely underpinned by wages growth, which in turn is largely driven by the tightness of the labour market. And this has been, I think, the biggest shift in global markets in the past 6 months. It's what's led many, myself included, to move from fearing a hard landing for the US economy to a soft landing. And this is because if you look here, we've got the US job vacancy rate in orange. And so again, there's a survey in the US of how many vacancies businesses have. It's running at something like 9 million at the moment. It's still a relatively high level, but as a share of the workforce, it's around about 5% or so. But as you can see there, historically, so going back to late 21, early 22, we had a very high job vacancy rate and we had very low unemployment. So that excess demand for labour, wages growth was running very strongly. And historically, the only way that's been resolved, i.e. getting wages growth back down again, getting job vacancies back down again, is to slow the economy and typically tip it into recession. So if you look at 2001 there and the GFC in 07, 08, when job vacancies declined, almost at the same time, we had an increase in the unemployment rate and the economy did tip into recession. But as you can see there, job vacancies have, it's not a straight line. There's been, in fact, only last week we had a bit of we did have a bounce back in job vacancies, but the underlying trend has still been down. And so for the past 2 years, job vacancies have been falling without as yet an increase in the unemployment rate. And how is that possible? It's because the excess demand for labour is being closed by a rebound in labour supply, rather than a contraction in labour demand, which has been the typical way that's happened in the past. So that is a very, welcome development, because it does mean that if excess demand for labour narrows, more people coming back into the workforce, more immigration, filling those available jobs, then wage pressure is easing, and we're seeing that easing. We saw in the payrolls report on Friday that it was easing. And the Federal Reserve doesn't need to keep jacking up rates and pushing the economy ever closer to the tipping point and going into recession. And we're seeing now the Federal Reserve itself is saying, we think we're done in raising rates. We may not cut interest rates quickly or anytime soon, but we probably don't need to raise rates much, if at all, given the sort of underlying trends we're seeing in inflation. Now, oil prices, what about oil prices? I may get that question. Just a quick 5-second view on that. I mean, oil prices, obviously, firstly, they have mixed implications for the economy. They do add to inflation, add to headline inflation, but they also slow consumer spending because, spending on petrol is fairly inelastic. It's people don't easily be able to substitute away from using their cars for work and pleasure. And so to the extent they have to spend more on petrol, they have to spend less elsewhere. So it does actually slow growth as well. So that in and of itself means it's mixed. Oil prices, ultimately at the moment, it comes down to Saudi Arabia. And the OPEC have tightened supply earlier this year, in fear of a slowing in global demand. 6 months ago, everyone was fearing a recession. They haven't, as those recession fears have abated, oil prices have bounced back up, but as yet, OPEC haven't increased supply again. But if push comes to shove, if oil prices do become a risk to the global economy because of inflation, because central banks reacting harshly to that, or becoming more hawkish, I think Saudi Arabia will come to the party and increase production again, because they don't obviously want to cause too much demand destruction. The other new variant on that, of course, with the Hamas, attack on Israel, what may happen to Iranian supply? They produce about 3 million barrels a day, export 2 million. There were hopes that we would get a bit more supply coming out of Iran, but that's a new risk factor for oil markets, because if we tighten down on Iran, because they've been implicated in this attack, if US go harder in their sanctions, we may get less Iranian oil on world markets, and that may push. That's why oil prices went up, for example, over the weekend. But again, if push comes to shove, Saudi Arabia, who has ample spare capacity, could come in and supply that. So it really does boil down. The key factor in the oil market at the moment is that there is enough spare supply if need be. At the moment, it's been artificially restricted, but if need be, it can come back into the market. But that's, I guess, my quick take on the oil market and the inflation risk from that. Just in terms of Australia, look, similar news here. These are various measures of inflation in Australia. Generally, over the last few months, even headline inflation has surprised on the downside. You can see the monthly headline CPI has now eased to from what was over 8% down to about 4.9%. The trim mean, the underlying measures of inflation, have broadly gone from around about 6 to 7%, down to around 5.5%. Now, headline inflation will bounce back over the next couple of months at least because of the bounce back in oil prices. But again, I think this is something that central banks at this stage can look through, provided oil prices don't keep going up 10% every month, which I don't think they can. Then eventually that effect on headline inflation sort of drops out of the numbers, and provided it doesn't influence inflation expectations, underlying inflation, then central banks can kind of look through that to a degree. So what does all this mean for markets? So basically, if you look here, I'll focus on the US and the Australian market here. So the first slide there is the US Fed funds rate. You can see there it's now at about basically 5.5%. Very significant tightening over the past year. The dotted line is the market's expectation for that Fed funds rate 12 months forward. And to me, that is the key underlying driver of where bond yields go. When you're thinking about, where do I see bond yields in 12 months' time? Basically, I ask myself, well, what do I think the market will be expecting the Fed funds rate to be in 12 months' time? So what will its 12-month forward outlook be? And at the moment, you can see the market it's been choppy, but over the course of the last, 6 months or so, the markets have gone from pricing in, rate cuts back down to 4% on the 12-month view, back up to basically rates at 5%. And that's why bond yields have had a bounce back of late. And you can see on the bottom slide there, that 12-month forward rate, as the markets have basically priced out the risk of rate cuts, you've had bond yields sell off, and bonds relative to cash have underperformed, as you can see on that bottom slide. So bigger picture, when you think about bonds versus cash, it really comes down to the direction of bond yields. So if you think bond yields are broadly peaking and are headed down over the coming year, then you'd want to be overweight bonds versus cash. Now, the timing of that, we've probably been a little bit early in that. We were overweight bonds, and they've had a bit more of a sell-off in the last couple of months. But the picture, I think, hasn't really changed, in that underlying inflation's coming down. Central banks are going to be probably cutting rates, maybe not the first half of the year, but probably by the second half of the year. And so, in terms of that 12-month forward cash rate expectation, I don't think it's going to go much beyond current levels of 5%. And as a result, I don't think bond yields are going to go much higher than. In fact, bond yields have sold off more than I would have anticipated, given this relatively modest shift in policy expectations. The same story applies in Australia. You can see there the RBA cash rate, the 12-month forward. At the moment, the markets have got a neutral outlook on the RBA. They think on a 12-month view, rates will broadly be, where they are now. The pricing in some chance of one further rate cut, and then one further rate hike, then a rate cut toward the latter half of the next 12 months. Net is no change in the expected policy rate. But you can see here with that bonds, generally speaking, have they sold off last year. We all know bonds sold off relative to cash last year as bond yields went higher. Then they stabilized for a while, and we've just had another leg lower of late and again, the way I think about it is simplistically, the bond market moved from fearing recession. It was pricing in rate cuts in the first half of next year, to saying, okay, well, there's a soft landing. Now, that's great news, but it probably means that they won't be cutting rates as quickly as we thought. So bonds need to, price that in, and that's sort of what we've seen happen. In terms of the equity market, again, this is the sort of a snapshot of global equity fundamentals, if you like, and you can see there that broadly speaking, the first slide there is the ratio of global equity performance to global bond performance. It broadly matches equity. So if you're bullish on equities, you're generally going to be, equities going to be outperforming bonds. You can see there, since late last year, we did have that sell-off in 2020 where equities underperformed bonds, growth assets underperformed defensive assets. We've had broadly a rebound since around October. More recently, just a bit of a pullback, but markets have bottomed late last year, and equities have been broadly outperforming bonds ever since. As you can see, the main driver of that though has been the PE ratio. Forward earnings over this period have been broadly flat, and that's because markets have been downgrading the expected level of earnings for both 23 and 24. Even though they expect level of earnings in 24 to be higher than 23, the overall expectation for both have been coming down. The net result of that is forward earnings, which is a sort of weighted average of expected earnings over the next couple of years, have treaded in a sideways kind of path. So all of that rebound in the markets has been the PE ratio. At the same time, that means that the earnings yield of the market has fallen. And with bond yields going up, it means the equity, the so-called equity risk premium, and I've got it there labeled the equity to bond yield gap in the lower right corner. You can see that's narrowed to a quite, the lowest level since 2007. So, one wrinkle for the markets here is that valuations are pretty stretched, particularly relative to the bond market, given the equity risk premium is now down at 2%, the lowest level since 06-07. So why not be super bearish on equities? Well, because if we do get the soft landing, a couple of things are going to happen. Firstly, bond yields should peak and start to come down. That's going to help their equity bond yield gap widen again. And also, if you look at the earnings expectations on the top right corner there, the markets, yes, they've downgraded expectations for 24, but they're starting to level out. And if the expected level of earnings in 24, about basically a 10% increase on 23, and even 25, you can see there they expect a further rebound in 25. Forward earnings, which are already rising, should continue to keep rising. So earnings are going to support the market as well. So we're definitely conscious of the fact that valuations look stretched, but it's because the equity market to an extent has run ahead of the fundamentals. It's been rallying on the hopes of a soft landing before we've had a decent decline in bond yields or a decent recovery in earnings. But the fundamentals we think are going to gradually catch up to the market. And the other point here is just a realistic one, in that trying to time markets is very even a day trader who sits on this screen every day can find it tough to time the markets. So certainly from a model portfolio point of view, where we meet quarterly, we can meet more regularly if need be, but generally speaking, trying to time corrections in markets, 5 to 10% pullbacks in the markets, usually very hard to get correct. And if you look at this slide, it's basically the grey areas are US recessions. The bottom slide there is pullbacks in the US equity market going all the way back to 65. So the drawdowns in the market. And the key of that is that the big bad bear markets, i.e. 20 to 50% declines in the market, usually always require a US recession. Outside of US recession, we have had a few corrections. Often I've labelled them the Fed, for example. Often you get sort of tightenings by the Fed or mid-cycle tightenings, which do cause a 10 to possibly 20% correction in the markets. But they're usually pretty short run. And if anything, that's an opportunity to add some risk exposure if you think the Fed tightening is not going to lead to a recession. And so you can see that in those examples. So the mid-60s, the mid-70s, the mid-80s. 87 was an example where we had a large equity correction without a recession. That was the famous time where the markets fell 25% in one day. It's a bit of a market dislocation, but you can see the market quickly recovered from that. Other one was 98, the Russia debt default. Again, the markets did drop 20%, but bounced back pretty quickly. It wasn't followed by a recession. More recently, last year, we did get a greater than 20% decline in the market, something like 25%. But no recession as yet, knock on wood, and the markets have, rebounded, fairly quickly from around about October. We're still not back to our peak levels, but again, that gives us, this framework says to us, unless you think there's a material risk of a US recession coming and the high inflation and the central bank's hell-bent desire to get inflation back down again was a pretty big risk of that happening, trying to, sit underweight equity markets waiting for a correction is probably a losing proposition, and we would rather at least stay neutral, and if value presents itself, act accordingly. Just to conclude on so the other sort of interest, so that again, just to summarize here, within the defensive asset, within the growth versus defensive positioning at the moment, we have no longer see a greater than 50% chance of a US recession. We think there's a soft landing because inflation is coming down. Central banks aren't going to have to force the economy into recession. So we've gone from an underweight growth position back to a neutral position. You could get a correction. We are in the midst of somewhat of a correction, but we don't see that as a to tactically time remaining underweight growth assets. Within the defensive parts of the market, we like bonds because we think, broadly speaking, bond yields are going to be falling over the next year, and so we want to be positioned for that. And then within the equity area, and I've got the two tilts that we focus on there, Australian versus global equities and listed property versus Australian equities. Excuse me. See there, look, the broad trend is of Australian underperformance since the GFC. The past decade has been one of global technology dominance, particularly the big US tech companies. Virtually everything globally has underperformed big tech over this period. Australia had a bounce back in performance last year when bond yields rose and tech had a sell-off, but since then it's unwound. We're in two minds about the one-year outlook for Australian versus global equities, because on the one hand, we think bond yields are going to be falling, which favours growth, it favours technology, it doesn't favour the Australian market. On the other hand, value has underperformed, and Australia is sort of in that value kind of bucket because of our exposure to the financial sector in particular, but also energy as well. And if we do get a soft landing, if that becomes more and more, the base case and markets rally on the basis of that, we may get a value catch up. We may get these unloved, relatively cheaper parts of the market catching up. So we're keeping a neutral outlook on that at the moment. Fully, and as you said, from a backdrop where we already have a 60% strategic allocation to global equities relative to within the equity bucket, if you like. The second one there is REITs versus Australian equity. So again, just on that slide, you can see there what I've got on top of that is global value versus growth. So it's the global index of companies with below average PE ratios versus companies with above average PE ratios. That's how value versus growth work. And it's usually basically energy and financials on the one hand being in value versus technology, consumer discretionary being in the growth areas. And again, broadly speaking, when growth is outperforming, value is underperforming growth, Australia tends to underperform and vice versa. So we're kind of in that growth versus value bucket, very broadly speaking. REITs, one key kind of driver of that relative performance is bond yields. You can see there that, with the sell-off in bonds last year and the sort of leg down that we've had more recently, REITs have generally been underperforming equities, underperforming in the Australian market. REITs look attractive on a valuation basis. If we're bullish on bonds, we should be bullish on REITs, but we're sort of holding fire on that view at the moment. There are obviously some structural issues going on in the listed property sector as well, with the work from home, and the sort of excess office property at the moment. So we are conscious of that. We may well go overweight REITs if the bond market clearly starts to turn around, but At the moment, we're retaining a neutral exposure. And again, REITs anyway in the models, so we definitely have them in there, but it's the strategic allocation is not that large, as 3 to 5%, and so it doesn't really, that tilt doesn't really sway things too much. But it's a tilt we can and will make when we consider the conditions right. So I will leave it there. That's just the framework for our thinking and why we're positioned as we are at the moment. Oh, sorry, just one final slide. Just in the interest of time, I'll quickly. We do have the smart beta allocations within the models as well, as Craig mentioned. So global quality, US equal weight, which is effectively a value type of exposure within the US market, because the market cap index is very heavily weighted to the big tech companies. And then our RAFI fundamentally weighted index. And you can see there, these are the relative performances of those indices to the market cap benchmarks. Broadly speaking, we don't tactically time these smart betas. We keep them there as a strategic allocation and let them do their work over time. And generally speaking, they do outperform over time. Certainly the evidence suggests that, albeit not all the time. And why we've blended these different smart beta exposures is that when one's outperforming, when one's underperforming, typically another one outperforms. And so quality tends to do well when value types of exposures such as the S&P equal weight and the RAFI underperform and vice versa. So we keep them in there and have that blend, and over time the evidence suggests that can add some alpha just from a pure strategic beta allocation. You can see there, so quality has bounced back since late last year. RAFI has bounced back more recently. Equal weight is still under pressure because the big global tech companies are still outperforming at this point. And that's the summary of our positioning. If there's no questions, and I don't see any questions have arisen, I will hand over to my colleague. Is that right? Is there one? No? Great. So with that, I will hand over to Damon, who's going to talk about practice development.
Thanks, David. And just to reiterate Craig and David's thoughts, thank you everyone for joining us today. I'm just going to give you a bit of a brief overview on some of the practice development initiatives that Betashares is looking at and has implemented over the course of the last 9 or 10 months. We've got lots and lots of things going on. So I just wanted to give everyone a bit of, a little bit more insight as to the reasons why we're doing what we're doing and how it's come about, and how we see this initiative growing, over the coming years. So we might just go through the first slide if we can, please. So in terms of why has Betashares launched into practice development, might be a question that you've pondered. Look, I think over the years, what's happened is Betashares has really become an industry leader, and we wish to continue in that vein by making sure that we're best able to support you as advisors in your day-to-day functions as advisors and as small business owners. We really want to become a much larger part of the value chain for you guys. Our belief behind that really is that if we can help you grow a bigger, better, stronger business that's more effective, more efficient, that's a great thing for you guys, but it's also hopefully a good thing for us. We also know that a lot of advisors out there in the market have been entrusting us more and more with a more significant portion of client funds. If I reflect back on where we were 7 or 8 years ago, a lot of advisors out there would give us a smaller portion, I guess, of a model portfolio that they may have created themselves, or perhaps been following a dealer group model. I reflect on the changes that have occurred, over that time period to where we're at today. What we're seeing really is very much advisors outsourcing more and more. Our SMAs are a very good example of that. And we're just getting a larger portion of client portfolio. So we want to make sure we're on the front foot and providing as much support as possible. Also, in recognition of increased compliance and regulatory hurdles, I do separate out those two intentionally. Whilst there is overlap, compliance really is imposed on you by dealer groups. Regulatory is government implemented, the reforms that have come about over a number of years. Interestingly, what we've seen is that whilst, with the some of the more recent reports, there's been recommendations around making things a little bit easier. Whether your dealer groups sort of take that on board or whether they don't, that could be a very different outcome there. So we do try and separate that, but we do recognise that it is a much, much tougher environment for you guys to do business than it ever has been in the past. As part of that, we're also seeing a very large increase in self-licensed businesses. And of course, if you do choose to go down that track and license yourself, one of the things with that is that you do tend to lose some of the support functions that you may have had previously from a dealer group. So we're very much about looking to fill that breach for you. Also, more of the changes that have come about with, we're seeing AI becoming increasingly important. Technology changes, I think, are making certain aspects of your role slightly easier to do, but the flip side to that is that we think that some of the soft skills will become more and more important. The way that you deal with clients, the way you communicate with them, the way you put together your service packages, pricing, all of those types of issues, those soft skills will become increasingly important. The other thing to recognise is that there will be a very big changing of the guard. We know that the average age of advisors at the moment, sits in the early 50s. If we look at that over 10 or 15 years, it means that we're going to have a big influx of new advisors coming in. And a lot of those guys won't have had the benefit of the skills or experience that current day practitioners have got. And lastly, look, we want to provide one-on-one support. We think that works. That is the most effective way to bring about change in a business. So we can just move on. So what have we actually done? What does, we've coined it business acceleration services. This is the complete package or service offering that we've put together to try and support advisors in their businesses more effectively. If we go through it here numerically, we start off with portfolio analytics and construction. This is where we can provide support and portfolio analytics around the portfolios that you're using, whether that be our separately managed accounts, whether it's putting together your own portfolios, whatever it is, we can actually provide you with analytics that sit behind all of that, so that when you're in front of a client, it can demonstrate that you've done your due diligence. You can explain the impact of, what's happening in those portfolios. Secondly is our capital markets and insights. That's the team that encompasses David, as you've heard from, our chief economist. But with this team, we're able to give you further insights as to how you might position or tweak portfolios over time. Thirdly is our responsible investing. We're at the forefront here in terms of ESG investing, and I think that's very much in recognition of the fact that our screening processes are second to none. We can give you lots and lots of insights where we're in a thought leadership position with ESG, real stewardship position. We want to bring all of that to light for you and make it easier for you to deal with those clients that are skewing towards those ESG preferences. So we do have particular client fact-finding tools and engagement tools that can help you with that. And lastly is practice development and marketing support, which is where I come into it. So we're very much looking around things like developing a client value proposition, helping you articulate an investment philosophy, looking at issues like behavioral finance, elevating levels of trust with clients, numerous things. The really important part here is that we've built our program out in a way that I like to think of as being very sequential. We're starting with the real basics, which what we've found is that, for you guys out there day to day, dealing with clients, sometimes it's very tough to put aside the time to do some of those basic business planning things that you probably should. And most people come back to work in January with the best of intentions of doing a business plan, constructing their client value proposition, looking at their marketing. But before they know it, they get to June and not much of that has happened. So we want to play a much bigger part of that process. So you can see here some of the tools that we do have available. They do sit online. I've constructed these and developed these. What I've done is essentially scoured the world for experts in their respective fields and used some of their materials. And I've intentionally brought it together in a format that is short and easy to use. We know from research that if we give you tools that are going to take days and days to get through and require huge amounts of manpower, the chances of it getting done are pretty minimal. So all of the things that you see here, whether it's about generating referrals from inside of your business from existing clients, whether it's about investment planning, whether it's about putting together an investment philosophy for your clients, or making sure that you've articulated your client value proposition, we've got these tools available online for you. I also do some one-on-one work with different practices in helping develop these. But if you want to do it by yourself, I'd certainly encourage you to look at our website, download the tools. All of them have been put together with a maximum time frame of 2 to 3 hours. Where if you're able to, we find that getting the rest of your team involved in this can be a very good activity to get different viewpoints from within your business. But you should be able to get through all of these tools in a pretty short period of time. So what have we done? Aside from the ones that we just looked at, we've got lots of different topics. So once again, I direct everyone to have a look at our practice development page on our website. There's lots of useful tools, but we've looked at issues really that are going to help you have hopefully better interactions with clients and present information to them in a way that makes the whole process of financial planning more comfortable and hopefully easier with better outcomes for both you and the client. But we've looked at topics like behavioral finance. So how do you present information to clients? How do you understand the investment biases that they operate with? We've undertaken sales training with some practices to make sure that once you put together those fantastic financial plans for clients, that you're able to communicate to them to get the best outcome and get the best rates of adoption. Estate planning, tips and traps, things that you can look out for. Business planning and investment philosophy, as I've touched on. We'll shortly be releasing a piece on pricing. What's the best methodology of pricing to use in your own practice? What are the industry averages and how might you go about constructing a pricing methodology and service package that's effective for your business? We've also commissioned we're in partnership with the University of Western Sydney, who are delivering some materials to us that's based on rigorous academic research. The first of those will be building trust with clients. How do you elevate levels of trust with clients to make sure that you're maximizing that? That research and those tools should be out within the next 4 to 6 weeks. So we look forward to bringing that to you in a very short period of time. So that's a real snapshot of what we're doing, what we've got in play at the moment, some of the things that we're looking at. But needless to say, we've got lots and lots of things. We're looking to partner with industry experts to bring you the best insights that we can with the aim of helping you run a stronger, more efficient business. So look, on that note, I might leave it. If there's any questions, I'm happy to take them. Otherwise, I'll pass back to Craig for some closing remarks.
Thanks, Damon, and thanks, David, for your presentations. As I said at the start, there will be a recording of today's session circulated post this event, so please feel free to share that with any interested staff or colleagues that were unable to dial in. I don't think we've got any questions for anyone in Sydney who wants to check if they're there, but I don't think there are any. So I'll wrap it up by saying thanks to our presenters today. Thank you to everyone who has dialed in. If you have any questions or want to discuss further, please reach out to us and look forward to speaking with you again soon. Thanks very much.